Alright, I'm going to skip the comparative advantage, absolute advantage. If you have any questions on that, please DM me. Text, call, write your local congressman, whatever you need to do. Closed versus open markets. A closed economy focuses only on domestic price and trades for the lower world price. Export goods and services, 60% of the American GDP, and U.S. exports have doubled as a percentage of GDP since 1975. That brings us to the balance of trade and payments, and I think this is where a lot of questions lie. Initially, the first thing you need to understand is what a trade surplus is and what a trade deficit is, or trade gap. A surplus is where you export more than you import. A deficit is where you're importing more than you're exporting. The winners of this, the United States. We are the furthest in the negative out of any country. We are 190. We win at something else. So when you look at balance of payments, it's better than balance of trade, because balance of trade only talks about goods and services, period. Balance of payments considers all international transactions. Balance of payments is a broader measure of international trade. And just like GDP, it's one given year. It's prepared in the domestic country's currency. So if we're talking about Mexico, we'd be doing the peso. If we were talking about Spain, the euro. Great Britain, the pound, and so on. And balance of payments is made up of two accounts. The first account being the current account. The second account being the capital account. Two different things. The current account is made up of three parts. One, goods and services. So the difference between our exports of goods and services and our imports of goods and services. So tourism imported from China, U.S. cars exported to Mexico, the end. There's also the investment income. Income from factors of production, including payments made to foreign investors. And vice versa, there's to us. And then the last one, net transfers. This is money flows from the private or public sectors. So when little Fidelito sends back money to Mexico, net transfer. When we give official assistance to like Haiti after the earthquake, net transfer. The capital account's a lot easier. The capital account measures the purchase of sale of financial assets abroad, solely just financial assets, namely the purchases of things that stay in that country. So like a hotel in Russia, or a Korean company that sells a factory in Ohio, or dividends earned by Chinese citizens in the New York Stock Exchange. All straight capital movement. So we had this practice, and if you want, take a second, pause this, and see if you can figure out which one of these is capital account, which one of these is current account, and then if it's a credit or a debit. A credit is a positive to your account. A debit is a subtraction from your account. So pause it, take a few seconds, and go over the answers, and then I'll put the answers up in a second. I hope you paused it and went through this. If not, you just had me pause for 3 seconds for fun. Here are your answers. Go ahead and pause it, look over your answers versus what you have, and if you have any questions, DM, call, email, text message, smoke signals, Pony Express, whatever you got to do. We have our questions here. If you want to pause that and see how things go back and forth, go right ahead and pause. We're just going to keep it moving. This is a possible FRQ question. With these FRQs, these practice ones, look at the answer and work backwards. See if you can find out the logic behind why these answers are the answers they are. That brings us to foreign exchange, Forex. Foreign exchange, with that, what you want to do is understand that with foreign exchange, you're just talking about how much it costs in my currency to buy another currency. You're essentially purchasing currency on the foreign exchange market. And so when we look at it, and this slide might be a little confusing to you, we're looking at the price of the US dollar in terms of pounds is $1 equals 1 pound over $2, which is 0.5 pounds. There's mathematics to that. Essentially, dollar and dollar cancels out, so you end up getting 1 to 1/2, which is 0.5. And so, kind of like with comparative and absolute advantage, the reciprocal is true. So if $1 is half a pound, then 1 pound is $2. What happens if you need more dollars to buy 1 pound? So the price for a pound increases. Well, we talked about that being depreciation. The US dollar depreciates relative to the pound. And remember, the US dollar doesn't just depreciate. You never want to say it just depreciates, because that means it's gone down versus every currency in the world. Here we're talking about it depreciates relative to the pound. Depreciation is just the loss of value of a country's currency with respect to a foreign currency. Essentially, it costs more units of a dollar to buy a single unit of the other currency. This is where we say the dollar is weaker. What happens if you need less dollars to buy 1 pound, so the price of a pound decreases? Well, we say the US dollar appreciates relative to the pound, and appreciation is just the increase of value of a country's currency with respect to a foreign currency. You need fewer dollars to buy a single unit of another currency, and you say that the dollar then is stronger. And this is what the market graph looks like: supply and demand for dollars. So the price of US dollars, and the other way to do it is the monetary unit that you are talking about goes under the monetary unit you're exchanging. So this is the graph for US dollars. So over here you would put pound over dollar sign. And so you get an equilibrium price right here and an equilibrium quantity right here. And just like supply and demand, things are going to shift on here. The supply by Americans, the demand by the British, things are going to shift this graph back and forth. And you see here that as it goes up from that equilibrium point, we talk about the dollar appreciating. As it goes down from that equilibrium point, we talk about the dollar depreciating. So let's skip this one if you want to pause and read this. It's the same thing we've been talking about. If you demand a currency, you have to supply the other one. Just like if I demand a good, I got to supply money for it. Remember that we buy currency in the foreign exchange market. So change in taste. If all of a sudden British tourists flock to the United States, the demand for dollars will increase. Why? When you come to the US, you don't buy things in euros, you buy things in dollars. And so they get off the plane, they demand our currency. So our currency demand goes up, shifts to the right. Well, they just don't get our currency for free. They need to supply their British pounds. So the supply of British pounds also increases. What happens? Well, when the supply increases, the pound depreciates. When the demand for dollars increases, the dollar appreciates. You have changes in relative income. Usually that's going to result in more or less imports. So if the US growth increases US incomes, we all have more money. That means we're going to buy more stuff. So we buy more imports. That means that we are going to demand more pounds, supply more dollars. So the pound appreciates, the dollar depreciates. We have changes in relative price levels. Well, if US prices increase relative to Great Britain, what's going to happen? Well, we're going to demand cheaper imports. So our demand for pounds increases. The supply of US dollars also increases. The pound appreciates, the dollar depreciates. Changes in relative interest rates. And for this one, we're talking just about financial capital. We're just talking about people trying to invest their money and make money on that investment. The US has a higher interest rate than Britain. British people want to invest in the United States, so they make more money on their money with a higher interest rate. That means that capital flow increases towards the United States to put money in our banks and make more money with higher interest rates. The British demand for US dollars increases. British supply more pounds. The pound depreciates, the dollar appreciates. Here's more practice. I'm going to go through this. I want you guys to pause the video, answer as best as you can. And here are all your answers. Go ahead and pause this and see if you have any questions. Again, email, text, DM, I guess. And there you go. There's all of Unit 5. If you have any questions, please let me know. Thanks.